My name is Karsten, Berlage, as it says there. Who has heard of the company name Allianz before? Anybody ever heard? You know it? Some people know it. It's actually the largest insurance company in the world, only it's not really headquartered in the US. That's why probably some of you have maybe not heard of it. We do own some US companies that might be familiar to you, like the Hartford, for example, or PIMCO. You might have read in the Wall Street Journal a large article about Mr. Gross and Mr. Alarian not getting along, and that's why one of them left the firm. So there's a few others, Fireman's Fund, for example, that Allianz owns, but primarily the home market would be Germany. They have a large market share in Europe, and they do all kinds of insurances. You know, health insurance, car insurance, life insurance, home insurance, whatever you can imagine. So the retail, if you want to go and buy an insurance, that's what they do in those home markets. Here in the US and around the world, they do primarily insurance for corporations. And therefore maybe you don't see a branch of an Allianz or so. And that's Allianz. I myself, you can hear it from my accent, I am actually originally from Germany, born in Germany, went to college in Switzerland, in Zurich. I started working there for McKinsey, then moved to a bank, immigrated to the US to work on Wall Street in '97, and worked for 10 years in investment banking. Stopped that when the train ran against the wall in 2007. Looked for something else, and this company made me an attractive offer. First I thought, I don't know about insurance yet, but I'll give it a try. They asked me to manage a large structured finance fund of about $1 billion as a fund manager. Still do that on the side, but about 3-4 years ago they asked me to build out a weather insurance business. Anybody have an idea what weather insurance is about? Anybody even had an idea that you can insure against weather? What do you guys think? Anybody going to try it? And by the way, you said you're so shy you would not say a word. Prove it wrong. Do me a favor. What could it be? Yeah?
Maybe like insuring like houses, buildings, like anything that can be affected by weather.
Okay. And how could that be affected?
Like the hurricanes and stuff like that, flooding.
Mm-hmm. That's a good guess. Anybody else have a different guess? Yes.
Like flooding, wind damage, stuff like that.
Mm-hmm. That's a quite natural, good answer, but it's actually wrong in this instance. What we do is we separate weather and catastrophes. Catastrophes are hurricanes, tsunamis, earthquakes, things that happen very rarely, and if they do happen, they have a severe impact. When you look at risk, generally, you go by severity times probability. Anybody heard of that? Has anybody done any actuarial science? No? Statistics? Anybody? Okay, so if you multiply a large severity with a low probability, you get a certain percentage. And you get a similar percentage if you multiply a large probability with a low severity. Now, weather is the latter. Weather it happens very regularly, but it has a low severity. That means the regular temperature that we have right now outside impacts certain companies. Now, the difference between CAT, what you mentioned, and weather is that there's not, in weather insurance, no physical damage. Just by the temperature being what it is right now, doesn't necessarily destroy something. Maybe some more potholes created or so, but really it's not about the physical damage to a building or something. Why, if there's no physical damage, why would you still want to insure against weather? Yeah?
Loss of business.
Loss of business, perfect. Very good answer. And that's exactly what we insure. If you remember what I said before, we're really dealing with corporations. So we're not really even interested in houses so much. Theoretically, we could insure a head office against physical damage, but that's not what it's about. It's about the fluctuations of a business based on unfavorable weather conditions. Now, give me an example of a business, the type of business, and what weather they don't like. Anybody have a guess?
Ski resorts in warm winter.
Ski resorts, warm winter, perfect example. It's something that we actually do. Disaster for them, especially the Christmas week, is when there's a lot of people coming, booking. There's no snow on the slopes. You can't really sell the tickets. You can't sell the hotels, everything. That's a very good example. You have your hand up.
The ice storm on the airport.
Airports. Now that's an interesting example because what companies operate at airports? An easy one is? Airlines. Airlines fly flights. What kind of weather do they not like? You said ice storms, for example, because then flights are canceled. You go to the airport and you can see that maybe in my face. I was just recently at an airport, escaped the cold here for a week, and my family was freaked out about potentially not making the flights because we would have another snowstorm. What other companies operate at the airports that might want the opposite weather?
Concessions, restaurants.
Possibly, yeah.
Yeah.
There's de-icing companies, there is snow removal companies that actually get paid based on how many airplanes they have to de-ice the wings. They want the opposite weather. The crummier the weather is, the more they make money because they get paid by airplane that they de-ice. We do that. We insure a de-icing company, the largest one in the UK, we're at 11 airports, and they want the opposite weather. Insurance, the key ratio in insurance, now this would be a $64,000 question, so if nobody had actual science, I don't expect you to know, but maybe you do. Well, how is insurance measured? Combined ratio. Combined ratio is something that is a key measuring stick for an insurance company. And it has two components. It has a loss ratio and an expense ratio. Expense ratio is fairly fixed. Let's say it's 10–15% usually of the premium that you pay for insurance. The insurance company uses to pay for the buildings, for the salaries, for the travel, for the computers, for the regular expenses. That's more or less fixed costs, whether we do business or not. I mean, eventually, if we don't do any business, we fire the people and close the buildings down and that's it. But that's expense ratio. The key number in the combined ratio is really the loss component. Now, the loss component in insurance is statistically derived by what do I expect would happen. Let's say you, for example, have a car, you want a car insurance. You go to the car insurance company, you would have to say, I'm female, I'm this age, I have this much experience driving, and this is the type of car I have, and then they look up what is the probability that you will have an accident that costs a certain amount of money, and that's how they derive your premium. And the premium is, again, measured by, let's say, about 60 or 70% of that premium. Statistically, if we have 1,000 of just you, the same type of person, then we expect to pay out of 1,000 that we generate in premium income, 700 we would pay back. That's the loss ratio, that we have. And those rates are filed. We can't just charge 2,000. We're only allowed to charge a certain number based on the probability that we would incur a loss here. Now, back to my weather insurance. When I have 100 cars like hers and she has an accident, what's the probability that the other 99 also have an accident? Not necessarily correlated. All the other guys in the class might just drive without having an accident, and only she has an accident. So there's not really a correlation directly. However, if I have 5 different airlines that want to cover crummy weather at JFK or New York Airport, and one of them has a problem, what do you think happens in my weather insurance portfolio to the other 4? I have an issue. Because then probably I pay to all of them if I have the same type of risk. Now, if you were me, this is entrepreneurship, I heard. If you're a manager of a weather book, how do you try to improve your loss ratio now as an insurance company, as a manager of this business? to avoid that one airline has a problem, all of them have a problem, and I lose my job? How can you mitigate that risk? Yeah.
Choose not to cover that risk.
That's one way. Not doing any business, then you can't lose.
Increase preparedness.
Increase.
Preparedness, being ready for something to prevent it from happening.
The problem is, if I insure weather, I can't really influence that much. I mean, if I insure a certain temperature or a precipitation, snowfall or rain, it's going to happen. You know, so that part I can influence, which is good, but it's also a problem. Yes.
Maybe lower their premium if they take steps by themselves to reduce that risk.
That is a good possibility, but I was not thinking that way, but that's not wrong. Yes?
Increase the price in the cover.
I could increase the price, yes, but I still have the same problem that all the 5 airlines are being hit.
Diversify and choose one airline.
Diversification, that's a key word in finance. You got to diversify. How can I diversify when I have a weather book? Be in my shoes for a second. How could you diversify? Yes?
Different locations, different weather, warm weather, cold weather.
Perfect. Geographically, I can diversify. That's why I have to travel a lot around the world, because I don't want to have only airports in New York. I want to have airports in Brazil, in South Africa, in Australia, in Indonesia, everywhere. Because I want it in places where the weather is not necessarily correlated. So that is a perfect answer. And that's what we effectively do. My weather book has exposure in all continents. That's one. The other one you said is opposite type risk in terms of the weather peril. You said cold temperatures, warm temperatures. So the example that we used with the de-icing company and the airline is, that's the perfect scenario. I'm at the same location and I have opposite type risk. If I calculate them both on 70% loss ratio, if I put them both in my book at the same time, then my loss ratio is going to improve. Let's say it goes from 70 to 50 to make it easy. My expense ratio is still 10. So if I have then 60, 50 plus 10, then my margin increased from 20 to 40%. I just doubled my margin by your idea of putting opposite risks on my book. That's one thing. Another thing would be to put different perils on the book. So one company wants to protect against an unfavorable temperature. The next company wants to protect against rain or no rain. You have in agriculture, for example, you have companies that need certain rain to water the fields, otherwise they have to irrigate, which is more expensive, or they have other problems. So some companies want rain, some other companies don't want rain. You can diversify by geography, you can diversify by weather peril, and you can diversify by time. I try to do not all the deals at the same time. If I have a temperature deal in the winter time, I try to put other things on in the summer. It's more difficult for me to find somebody doing the moderate temperatures in the fall and the spring. But some companies want it year-round. So let me go through some of these slides here. That was just as an introduction. So why do we care? What can be protected? How does it work? That's kind of my outline. Some of these pictures here, probably intuitively, they all represent a problem, and you can probably explain to me what the weather issue is that we're talking about here. Anybody pick one? This one you already mentioned. This one, huh? For any skier or snowboarder, this is a miserable picture. This one, everybody was frustrated about probably when we had to pull up vortex. What else do you see? It's a problem. What?
Wind turbines are not moving.
What do they want to protect against?
The inability to produce, wind power.
Right. In simple terms, the more the wind blows, the more power you produce as a wind farm operator. So you want a lot of wind. I'm going to get to that example in more detail later.
The low tide.
Yeah. Well, so that's this one here. Yep, you can low tide, high tide, if you will. You know, if you have certain river operations and the river is too high, you cannot, you know, put as much on barges. When the river is low and high, you understand what in shipping that is a problem when you don't have the right river levels.
The low attendance? Is that a sporting game?
Yes, yes. Now, why would that theoretically be challenging for me? Like the Super Bowl, for example. They approached me, the NFL approached me and said, I want to protect against the Super Bowl. Everybody knows that was in New York. Everybody knew that they were freaked out about the snow because we had snow a couple of weeks before. Why is that an issue for me? Why do I maybe struggle with that one? Anybody have an idea? Insurance guys are naturally not risk takers. Okay? What is risky about, let's say, the Super Bowl or a certain event?
In terms of people not showing up.
No?
Loss could be massive.
Yeah.
It's
all or nothing.
Yes, it's all or nothing. It's very binary, digital, whatever you want to call it. You know, it's either snowing on the Super Bowl, I have a full payout, or it's not snowing and I have no loss. I like insurance more when it's a proportional risk. A little bit more wind gives a little bit better, more power, a little bit less wind, I pay him a little bit. That generally is better for insurance. I rather have 1,000 cars that I insure than only one car, because that's more a casino type thing. So if I have an event, I like to have lots of different events. You know, for example, we insure filming conditions. You know, picture a movie set where the director, you know, engaged Brad Pitt, for example, and they want to shoot outside in New York City. And they booked him for a certain week in New York. And, you know, they put him up in a hotel there, and the weather is not how the director wants it. But the following week, the weather is beautiful. Problem is, Brad Pitt is on a different assignment the following week, and you can't make your movie because in the week that you had scheduled him, the weather wasn't right. You know, it was raining or whatever, something. And they had to do it outside. So that is something we do. Again, I don't like to have just one movie. I like to have 100 movies, various locations and all that, to diversify my risk. That's what Professor Lee said. What about this one here? What's this? Anybody can see the picture? What is it? Hoover Dam. It's a dam, yeah? Not a Hoover Dam, but it's a dam. Water, hydropower plant. Insured last month, we insured the large hydropower operation in Uruguay. I mentioned to you that I want to be everywhere, so Uruguay is a good location for me because I don't have a lot of other risk close there. And they wanted to insure 450 million insurance limit. It's a pretty large insurance limit. What do you think they are worried about? A hydropower plant. Drought. Drought. Not enough rainfall. Rainfall fills the reservoir and produces power. Now, if there's not enough power, not enough water and power production, what they have to do, this Uruguayan utility, in order to produce power, they have to buy diesel fuel, oil, basically, and make power like that, and then deliver the electricity to the people of Uruguay. Now, we structured this deal as first we determine not enough rain, so they get a payout. Now, in the case that they don't have enough rain, they have to buy the fuel. So the amount that we pay out to them is on a second trigger, which is the amount of the oil price. So these structures are not necessarily just gambling, which that example here of snow or no snow at the Super Bowl would be, but can be fairly structured. Here are a few examples, and you guys have mentioned some to me, and I think the professor is going to give you those slides so we can go on. What I want to highlight here is that a company is hit by weather risk from various different angles. On the supply side, on the demand side, on the operational, in operational matters, and then this one we leave out for a second. So what I mean here, supply side, we talk, for example, the wind So supplying resource to the wind turbine to produce power. That's pretty clear. Demand side means you're maybe not buying a new snowboard in November or December. If it's very warm and you expect this winter, I'm not going to board anyways. So that is a demand side. If it's unseasonably warm, you don't buy a winter coat. If it's crummy in the summer, the soft drink sales get hurt. You understand the demand side. Operationally, that was, for example, the barge operation, river levels, for example, or the snow, the de-icing. And then promotionally, Nikon Cameras has done a tremendous weather deal, got like Deal of the Year promotion. And probably, if I ask you, how do you think Nikon Cameras came up with the idea to protect against weather? You would say, there's not really a weather sensitivity, or can you find one? I couldn't, if somebody had asked me. So what they found out is that they're a public company, they have quarterly analyst calls, and they have to report quarterly, and they saw that in the fourth quarter they have great sales because everybody buys cameras for Christmas. And they have good sales in the second and third quarter because people go on vacation during the summer and they buy cameras. They had a terrible first quarter. And it was every year they were struggling how to smooth the sales. So they came up with the idea to offer customers a full rebate of their camera price of, let's say, a Nikon camera on average is $600. If you buy your camera between January 1 and March 31st, and it was rainy on the Easter weekend, which was the second weekend in April, you would get your full camera price back. And they sold a tremendous amount of cameras during the first quarter. People basically speculating. It cost them about $50 per camera in insurance premium. Their margin on the camera is about $200. So they sell it for $600. Their cost is $400. So their margin decreased from $200 to $150. Still a good deal to sell these additional cameras. Here are some others that have done it too. Just to give you an idea of how broad this is. Now we're getting into maybe more of what you guys are learning at school. Traditional risk management. When you talk about interest rates, foreign exchange, currencies, credit risk, property and casualty, that's your buildings, you have certain risk management instruments, like hedging instruments, futures, swaps, insurance policies, rules and guidelines that you have to protect against these risks. The main risk of a company is usually the volume risk, how much you sell, how much you produce. That is highly dependent on the weather. And that is something that most companies completely neglect and don't even know about. So if you have this cogwheel and you leave that out, you leave an important part of your overall risk management system out. So what we are saying is, in addition to the traditional risk management that every company pretty much does, you have to add weather risk management to really have value creation. What I mean by value creation, I'm going to get to in a second. Stakeholders. Everybody clear what stakeholders of a company are? Give me a few examples of stakeholders of a company. Who are stakeholders?
Investors.
Investors, shareholders, bondholders would be investors. Who else is a stakeholder? A stakeholder, my definition is anybody with an interest in the company. Who has an interest in the company?
Suppliers,
Yeah.
the community.
The community, yeah. People,
The staff.
the staff, people who work there, absolutely. The owners of the company, yeah. They all have an interest in the company. And they all pay increasingly attention to the weather risk of the company. Because sometimes, if the weather is really, really bad, it can even go to the livelihood of the company. If you work there, and it is so, let's say you work at a car wash, and it rains and rains and rains, and you can never even open your car wash because nobody comes and wants to wash their car because it's rainy. You have no job. Now, you can probably, if you are really working at the car wash there with the brush, I don't know if you can force the company to start using weather instruments. But, you know, you have an interest in that the weather is good. This one is interesting. They have researched, here's the study if anybody is really interested in it, they have researched companies that have systematically used weather risk management instruments, derivative products, and insurance products, and compared it with the shareholder value of companies that don't use it, and found out that companies that do use it create value. So 2 slides before, when I said value creation, if you add the 2 up, that's basically determined here in this study. This is interesting. Anybody know what a rating agency is? Probably most of you do. You have, a company has shares, you know, equity, and then you have debt. And debt could be a loan, and debt could be a security, bond. And those bonds, and sometimes even the loans, are rated by rating agencies. They give a classification how risky it is that you get your principal back. And if the company is a riskier company, you get a higher interest rate as the bond investor or loan, the lender. And what the rating agencies said, for example, this is one, Standard & Poor's, they said in the reports, if you have weather sensitivity, you don't protect against that, your rating can suffer. When the rating goes down, that means next time you issue new debt, you have to pay more for your debt. So it actually goes to your pocket. Clear? Okay. Elements of a tailored solution. We already established we want to diversify by place, by period, by peril. These are the different perils that I have, and sometimes I combine them. It's not always just temperature, just rain or snow, but different combinations of them. Payout, it could be just digital. Either it's happening or it's not happening, or proportional. I already mentioned that I prefer proportional. And there could be a second variable. For example, a power price in the example from Uruguay that I used. And who do we sell to? We sell down to retail customers. You can buy an insurance from me when you go on vacation and it rains, and I give you the price of your vacation back. You know, or per rain day, you get $100 back. Those 2 options I have. Corporations, institutions, even governments that want to subsidize, for example, their energy or their agricultural industry, they can come to us and, you know, reinsure that. How does it work? Now I want to get a little bit more technical. Identifying the weather risk is the first thing that a company needs to do. Even understand what is the weather risk exposure that we have. Then identifying it, then quantifying it, structuring the solution, and then executing it. So here I have just a few examples and use agriculture, for example. What could be, and I've mentioned some of this here already, problems could be flood, heat, freeze, and drought. What is special in agriculture?
Like the harvest?
That's good. I wanted to get there. The question was so broad, it was really badly asked, but your answer was much better than my question. You have 3 phases of a plant. You have a seeding phase, you have a growing phase, and you have a harvesting phase. Now, once the blossom is out, the weather conditions are different that you like. For example, you don't want too much water when you want to get your machines out to cut the grass or, you know, to harvest your field. You don't want the frost when you just put the seed down. So usually there's different phases, and each phase of a plant wants different weather conditions. So this can get fairly difficult and complex. Now, what we usually ask the client, where's the risk? The location is critical. What is the risk? When does the risk happen? And what is the dollar exposure that we try to find out? This is something that is a term that is very important here, and it's called basis risk. Basis risk means the difference between what we experience on the weather and what actually happens at the company. So we could say the airline has a problem because of freezing temperatures, but because it's, let's say, under 30 degrees. But it might be under 30 degrees and dry, and the airline actually does not really have a problem, and the flights are on time or anything, and we still pay out because we agreed on a contract with the airline that every day under 30 degrees they get a certain payout because we thought that would create a problem. Another basis risk issue is that I measure the weather at a certain location. Let's say the weather station, and there's meteorological weather stations all over the world. We buy data from thousands of stations. Let's say we measure here, here, and here, but actually the project location is here. Now you can have the risk that it rains here, but it doesn't rain at the location, or the other way around. So if, for example, you have a motorcycle track, there's something that came to us and asked to insure against the rain on Saturday morning, that when everybody comes out and wants to race their motorcycle, that the track is not slick and they get hurt and fall down. If you are only 5 miles away for rain, that's a big problem because rain is very localized. Temperature, not a big deal. You can measure a temperature 20 miles out and it's very close to what the temperature is unless you have like a microclimate in between with like a mountain range or something, or you're close to the coast. Generally, temperature is not a big problem. Basis risk for the hydro plant, for example, in Uruguay was a big problem. We had to fly down, we had to install 39 different weather stations to measure the rain at different locations and try to figure out where does the rain have to fall in order to go into that reservoir that ultimately wanted to have the water. So here I talk about step 2, the quantification. You can imagine that this is all about, ultimately we have to come up with a fair price. We don't want to screw the client doesn't want to be screwed, that's not good business. We want to come up with a fair price. And everybody hates insurance anyways because you think, if nothing happened, I just wasted the money on the insurance premium. And if something happened, then you're happy, but generally people are very against insurance, and I understand that. But then I ask somebody, so you rather have your house burned down so you can collect on the insurance premium, and then they say, no, not really, but still, I'm paying all this money for nothing. So what you have here is, daily temperatures, average temperatures. This is an example. This is the map, the real map of all the weather stations that we have. So you see that the world is pretty much covered with weather stations, even in Africa and places that are more remote. So this is an example of an energy company. Now, what is the worry of an energy company? Why is energy the sector that I do by far the most business with? What does energy companies make money on? You think they are happy about the last 2 months here or not? Here in New York and Northeast. They're happy or not happy? Oil.
Yeah, they're probably happy.
They're pretty happy because we all spend a fortune on heating, and they make a fortune on heating. So what do they want? They want extreme temperatures. Hot in the summer, so we crank up the AC. Cold in the winter, so we crank up the heating. That's what energy companies love. They don't like moderate temperatures. The base number, and what I say here, H to D 18, a temperature that is used as the norm in measuring all this is 65 degrees or 18 degrees Celsius. That's a temperature where we consider neither heating nor cooling. It's a temperature where you can open the window and you feel fairly comfortable. So energy companies hate 18 degrees Celsius. Now, HDD stands for heating degree days. So every degree of temperature per day that is below 18 degrees is a heating degree day. So on this day here, for example, the average temperature was 14.45. That is 3.55 below 18 degrees. So some people probably didn't turn the heating on. Some people might have. So this is 3.55. And then what happens with an energy company, you add all the HDDs up. And for the energy company, it's good if this total aggregate number of HDDs is fairly large. That means that the temperatures were very cold and a lot of people heated. If the number is low of the sum of the HDDs, then it's bad for us. So that's usually how energy companies structure it. Heating degree days, same in the summer, you use cooling degree days. Now, this example here is, I have to look at what I did here. Okay, this is hourly data. 1980, this day, this hour, this hour, this hour, this hour. This is a conversion. Here we measure the wind speed on an hourly basis, and John's example before of the wind farm doesn't care necessarily that I just ensure a wind speed. What they want to ensure is how much power they produce based on the wind speed. So what I do is I convert the wind speed to the output of power. Now if I have a different type of turbine, a 12 meter per second wind speed can create a different type of power. So that's why I create a theoretical power curve for a wind turbine that runs all the time. Now they turn it off to maintain it and all that kind of stuff, but simply said, here, the power curve is basically, can everybody see that? You have wind speeds that are low, you don't have the wind turbine running, and you have wind speeds that are very high, over 24, 25 meter per second, you have to turn it off or the blades would break down. Now, the ideal wind speed is between, let's say, 12 and 24. That's where you produce the maximum power with a wind turbine. Now, if you take 2 days and you say, okay, my optimal wind speed is, let's say, 15 to make it easy. You take 2 days and you have the first day, you have a wind speed of 3, and the following day you have a wind speed of 27. Then your average wind speed over the 2 days is 15. The perfect wind speed. However, how much power have you produced on the first day when the wind was 3 meters per second?
No power.
No power. And on the second day when it was 27, how much have you produced? 0. You've produced 0 power, but the average wind speed was 15. Perfect. So that is something that we analyze with the client and say, it is not just the average wind speed that you need to be concerned about. You need to look at the daily wind speed and the volatility of the wind. Now, if you're next to a forest, when you're onshore, the wind speed can be very volatile. You know yourself, sometimes you go out and it's very windy, and sometimes there's no wind at all. Now, offshore, that's a little bit different. Offshore, the wind is more steady and stronger, but what could be a problem offshore when you have wind? Why do I get exposure on offshore wind? Go back in your thoughts now to when we talked about the opposite risks. The waves are a problem. Why are the waves a problem? I mean, these wind turbines are 100 meters high. The waves don't go that high. So why is it a problem? Waves is a good answer, but gotta have to think of one more step.
Like erosion and maintenance costs?
Maintenance cost is very, very important, but it's not something that I cover in part of my weather business. Those wind farms have to be erected first, and you erect them at places where you expect a lot of wind. Now, the wind, you have a problem during the construction phase. I'm going to Switzerland next week when you wanted to have me, and I talked to a company called ABB. It's a large engineering company. They just published that they had 250 million euro that they lost in the 4th quarter of last year because of delay in offshore construction. Because these things are so huge, these monopods, that they try to ram into the ocean bed, and that, you know, and they rent barges that cost over €100,000 per day to rent. So they rent these barges long in advance from these construction companies, and then they have to just lay around and can't be used because there's too much waves, and those things would stand like this, and it wouldn't work. So you have certain conditions under which you have to work. That is, for me, ideal, because I like to have the wind farm, offshore wind farm, that is in construction phase next to the one that is operating, because the one that is in operation wants to cover the lack of wind. Now the one that is still to be constructed wants to cover the excess wind risk. Again, if I combine those two, I improve my loss ratio, and, you know, I'm a happy camper. This I explained before, the degree day things. What time are we looking at?
It's just 8:05.
Okay, I'm almost done. This is a new concept here in regard to weather. This is an example of an agricultural product. We do sell that to farmers and to other companies in the agriculture industry. Now, here you see that there is certain advancements. Now, this is probably not weather related. What you see here is historically the yield of that farm that is mentioned up here is the blue line. Now, we created a weather index for them based on temperature and rain that is the red line. Now, I'm pretty proud of this red line because it's not exactly on top of the blue line, but fairly close. Has a good correlation, 70–80%, something like that. The formula here shows you kind of the variables that we use. There's 2 or 3 different coefficients that we use for this. Now, what do you think? What is the problem with this line? And why do we have these dotted lines? The problem is that this farm was improving its efficiency in the way that they produce. They might have used better fertilizer, they might have installed an irrigation system, they might have used different seed, all things that have really nothing to do with the weather. And I try to detrend, take the trend out of the development to make it purely weather dependent. That makes, basically, if I take all those things out, I try to get here. Because I really only want to cover the weather. I don't want to cheat the client and charge him for something that is really ineffective to him or her. And therefore, I have to take all the effects out. And that becomes very difficult. You know, the airplane example. Was the airplane delayed or the flight canceled because of weather? Or was it because there was a mechanical issue or the pilot overslept? I mean, there could have been a bunch of reasons. And we try to isolate that, detrend it, to just have that effect. A different example here. This is 30-year average wind speeds. But you see on an annual basis, this is just the average. And I told you already what the problem with the average is. But just looking at the averages, it can go from below 80 to over 100, almost 125%. Now, you know, you produce different type of power here. Now, we talked about the stakeholders before. If you have, let's say, a lender, somebody who gives a loan to a wind farm operator, what is the lender really interested in from the wind farm operator? They just want payback of their interest and their principal. But they don't necessarily care for a year where they produce a whole lot of power, because all the extra money that they produce goes to the equity holders, shareholders, the owner, or something. So the lender really wants to cover the downside. So if the stakeholder that motivates the weather cover is the lender, then they buy a put. Everybody understands the put option? You buy a lack of wind put that basically covers everything under 90. So that's this example here. You don't have all but you cover just here. Sorry, this is keeping the upside. Then here, you cover the volatility. What you do here is you're willing to give up the upside and you cover the downside. So here you only have the risk left of between 95 and 105, the red line that I covered here. And because you pay me, you wind farm operator, pay me insurance company, in the case that produce more power, you don't have to pay me any insurance premium up front. Because we do a deal, you pay me here, I pay you here. And ultimately, you sleep well, and what this causes, this has a nice effect. Let's say it, for simplicity, it has 0 premium. So now you created an insurance product that basically ensures that you are not have no volatility anymore from 80 to 125, but only from 95 to 105. Now, Allianz has a rating of AA, which is a good rating. So you enhanced your credit quality as a project. That results usually in better financing conditions. Anybody heard of weighted average cost of capital? Yeah, most of you? Let's say a company finances with 50%, this wind operator, 50% equity, 50% debt. The equity usually is more expensive. Let's say it costs 10% and the debt costs 5%, in a simple example. Now, you have this AA insurance company, Allianz, who covers your volatility so that you really have very limited risk and the probability of your repayment is very high. The lender, the bank, might give you 70% debt. So now you finance 70% debt at 5% and 30% equity gets 10%. Your equity yield just got boosted because your weighted average cost of capital went down. Now I know this is quick, but this is all the things that people have to consider when they look at weather insurance and how to structure. Example that some people like to hear about, a jewelry company. Why have I just done a deal with a large U.S. U.S. jewelry company? What do you think is their concern? Now the ladies, I gotta hear one lady. Why is it a problem from, yes?
Are you losing the ring?
What is it?
Losing the ring?
Losing the ring?
Yes.
This has nothing to do with weather really. I mean, losing it in the snow maybe, but
I would say the cost that what company will expend trying to extract the jury, the cost that will cost them to bring the jury to the store again.
that's an operational risk. That's
Operational
possible.
risk.
But we don't have a lot of time, so I'm it's not taking questions right now anymore. The problem with jewelry companies is you don't sell it online, you sell it in the store. And you sell it, they sell 50% of their products within 4 weeks of the year. 2 weeks in December, 2 weeks in February. That's how jewelry business works here. And you don't have, you have a snowstorm like we had literally the 2 days before Valentine's Day, Wednesday, Thursday, disastrous snow, no mall opened. They lose a lot of sales, and therefore they want to cover against people not going out and to wherever and buying the jewelry. That's why we do it. Complication, this store had 2,000 locations, so we have to measure the weather at 2,000 locations. We have to determine what are the sales in those stores and how much should they be paid out if people actually don't show up. What is the snow amount that causes people to stop driving? You can imagine in Buffalo or Boston, that is a different number than in Atlanta or in Raleigh, North Carolina, where people don't have four-wheel drives. Pricing, the further out you go, further away from the average, the cheaper the insurance is. If you expect, in this case, where we have about 20 years, and you have 1, 2, 3 payouts historically, you pay less than if you have 1, 2, 3, 4, 5, 6, 7 payouts. Here, if you structure it at 65 or whatever that is, versus 50 or 53, if you are paid on this level, every 3 years you get a payout, you pay more for the insurance. So the premium is basically, you can determine the premium as a company based on the probability that you get your payout. Summary, really mentioned everything. I don't want to repeat myself, I want to leave some time for questions.